I remember I had these clients once who were very worried about risk management and planning for the nuclear scenario. Watch on for an analysis of their situation and definitely watch to the end for hopefully a few tips on how to recession-proof your financial plan. Hey everyone, I'm Andrew. I'm a CFA charter holder and a CFP professional who spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. And what I do is I take the learnings from those thousands of iterations and I give them to you so that you can apply them to your own situation. Today, I want to talk about some clients of mine who, again, were very, I don't even want to say risk averse. They were focused on risk management, right? They understood that risk existed no matter where they looked within their portfolio and within their plan. And they just wanted to make sure we had proper procedures and operating principles in place to protect against that so much as we could. The first note I would like to make is that good planning occurs in a non-emotive state. Meaning, if you want good future decisions, you need to have a framework for those decisions and plan for the possibilities before you're in a situation where things are emotional and the markets are volatile, okay? And they were in a situation much like we are now, where the markets had been good for several years in a row, and they had excess gains in their portfolio. And when I say excess gains, I mean relative to the rate of return they should have expected to earn, they had earned far and above that. What we did is we started with the framework of let's stress test your plan. Now, a Monte Carlo analysis, which is just a fancy way of saying a probabilistic analysis of your retirement plan, which spits out a figure of success or failure by trial 1,000 different times or 500, however many you run them. But Monte Carlo analysis does take this into account somewhat because there's a distribution of outcomes. However, it assumes from the starting value that you choose. So what we did is we said, what if the portfolio goes down 25% tomorrow? Then what does the success say, right? We ran it and we said all of your portfolio holdings are reduced by 25% as a nuclear scenario, a bear market scenario. And what the plan showed was they still had a very high probability of success. And so that then leads you down two different roads. The glass half full investor would say, fantastic, I can continue to stay equity heavy, even though I have this risk because I have a high enough base of net worth, I can withstand the drawdown from the equities. Whereas the risk averse investor, or the person who wants to manage risk, may say, fantastic, I now know I can take risk off the table and it's not going to hurt me. I can take those excess returns I've gotten off the table and it's not going to hurt me. And they fell more into that camp. So what we first did was they had a securities-backed line of credit, and I've talked about that in previous videos, so feel free to check that video out, where they had been buying some different businesses and properties through that securities-backed line of credit. And those assets they had purchased had gone up in value, right? Because the economy as a whole had done well and those holdings had done well. So the first thing we did was we reduced and paid off the debt on that securities-backed line of credit for two reasons. First, the idea that we don't need to hold that debt anymore. We've already gotten excess compensation over here, so let's take that and let's pay off any interest that we're owing. The second is having liquidity available in case opportunities arise in a recession. Right? There's an old Buffett quote, if it's raining outside, don't hold your hands open, get a bucket. We wanted buckets of liquidity in case the markets were to take a drawdown for them to be able to, through their line of credit, go out and purchase private business interests. So we first did that. The next thing we did is possibly counterintuitive. They had a high enough net worth that we were able to purchase 2 single premium income annuities, one on each of them. And I actually mentioned this in my last video, that pensions are all about mortality credits. And if you outlive your actuarial age, that's when you win. And they both had extremely high longevity in their family. And they wanted to make sure their base of income was taken care of. So we went out and we bought 2 plain Jane single premium income annuities. And what that did was, if they were to live out past 85-ish, it was a 5% rate of return locked in without interest rate risk. The only risk is you die early. But if they died early, they didn't spend down as much of the assets. And so their kids still got inheritance, and there were other funds there as well. They had a high enough net worth they could accept illiquidity on both ends of the spectrum. On the very risky end, they could do things like venture capital and private equity. But even on the very risk averse end, being able to take liquid funds and make them illiquid for an income stream, you're then transferring the risk to the insurance company from yourself. And in certain situations, it can make sense to do something like that. Finally, what we did is, they owned a few different businesses. The savings that we had in the retirement plan, we reduced by about half, reflecting a 50% drawdown in the earnings from their business. And we also decreased the EBITDA multiple that we had their business selling at on the back end, because many times in a recession, you don't only have the drawdown of net income, or in business cases, private business cases, EBITDA. You also have a retraction of multiples. You see this in the public markets as well. Not only does the P in the PE ratio go down, but the E goes down as well. Multiples tend to retract in private equity investing as well during recessions. And so when we put all that together, we then got a nuclear scenario look at their plan and realized everything was still okay. And so hopefully that cascading of events and decision-making framework is helpful to you when you look at your situation. And it illustrates the point, hopefully, of the power of both Monte Carlo and scenario analysis. It is not a mutually exclusive. It is not an either or situation. It's an and. And so to recession-proof your financial plan, what you do is you illustrate drawdowns in the markets and you see how it affects your plan. You understand the liquidity needs within your portfolio and what portions of your portfolio can be illiquid. You also, if you own private interests in businesses, you want to reflect that and make sure you're not incorrectly assuming top economic performance multiples at sale into a recession. So I hope that's helpful. And until next time, see y'all.